Good morning, everyone. This is Dana from NextGen, and I hope everyone is having a fantastic week. Well, for the next 2 weeks, I'm going to finish up talking about reverse mortgages, specifically the HECM mortgage. And we've been talking about that in previous videos, so I'll go ahead and leave that link up at the top for you. But this is something that Gregory and Natasha was looking into. So let's go ahead and answer some of the questions that came in from their review of reverse mortgages. Previously, we discussed the different ways Gregory and Natasha use the equity in their home to build generational wealth. So to be eligible for a reverse mortgage loan, Gregory and or Natasha had to be 62 years of age or older and have considerable home equity. Now, if some of the terms I'm using are unfamiliar to you, we discussed most of them in previous videos, which I will include. Now, because this program is always changing, I will include the link from the U.S. Department of Housing and Urban Development for the HECM program. Now, the HECM program is one of 3 reverse mortgage programs. Now, Gregory will be 59 years old next week, and Natasha will be 51 next February. And so although their home is paid off, neither one of them meet the age requirement. Now, if either one was 62 or older, the HECM program requires that they occupy the home as their principal residence, not be delinquent on any federal debt, have financial resources to continue to make timely payments on ongoing property charges, such as the property taxes, the homeowner's insurance, and homeowner association fees. And we talked about that because under the program, the loan is only going to be paying is only going to be deferred for the principal and the interest of the loan. Also, they have to participate in a consumer information session that is given by a HUD-approved HECM counselor. Now, this counseling session at this time costs around $125, and it takes about an hour and a half, and it covers the pros and the cons of taking out a reverse mortgage, and it looks into their unique financial and personal circumstances. Now, they can borrow now, if they were of age, the amount that they can borrow is dependent upon the age of the youngest borrower or eligible non-borrowing spouse, the current interest rate, which changes every week, and the lesser of the appraised value, the HECM FHA mortgage limit, and FHA falls under HUD, and that changes every year, or the sales price. Now, the reason I'm saying sales price is because they can also get a reverse mortgage if they were to purchase a home, and that's called HECM for Purchase. That's the name of the program. So, for example, when Gregory turns 62, Natasha will be 54. So the loan will be based on Natasha's age. The younger of the borrower or eligible non-borrowing spouse. So she would not be considered a borrower because she's not 62. But it will be based on her age, which is 54. So the younger the borrower, the younger the person is, then the less money they will receive. So at 62, it's already going to be low. But because they're basing it on Natasha's age, which is 54, it will be even lower. And if you think about it, it makes sense. So after Gregory turns 62, they have different ways they can borrow against their home value. And I think we discussed that last week. Now, the entire balance up to a limit becomes due and payable when either Gregory passes away, moves out permanently, or sells the home. Now, federal regulations require the lenders to structure the transaction so that the loan amount does not exceed the home value. And if you remember when we talked about if you borrowed $500,000 at 8% for 30 years, you will see that the interest rate actually exceeded 500,000. So if you think about it, it makes sense that they're not going to come anywhere close to the at that time the home's value. So if it does drop, if the home value drops, or if Gregory lives longer than expected, then neither Gregory, Natasha, or their estate will be held responsible for paying the lender the difference because of the program's mortgage insurance, which they're going to be paying at closing. So there's mortgage insurance to where they're not going to be, their estate or Natasha will be responsible if the loan balance exceeds the home value. So although Gregory and Natasha have assets outside of their home, they are investigating reverse mortgages because they wanted to look for ways to diversify their income, reduce investment risk, sequence risk, and longevity risk. And plus, reverse mortgages will provide them with a source of cash without requiring monthly debt payments. Now, with all of the potential positives of reverse mortgages, they were still concerned about generational wealth. So under the reverse mortgage rules, they have to stay current on the property taxes and homeowners insurance, and of course, homeowners association fees, which they have. And of course, to keep the home in good repair. Now, that's a requirement for the reverse mortgage, which is something they've been doing anyway. If Gregory is not living in the house for longer than a year, and that's even if he's living in a long-term care facility for medical reasons, then they would have to repay the loan, which in some cases requires them to sell the house. Now, despite all of the reforms, there's still situations where a spouse could lose their home upon their husband or wife's death. And next week, we're going to discuss foreclosures and how that can happen. Of course, they can always refinance the reverse mortgage. And because of the origination fee, upfront mortgage insurance premium, and other closing costs, refinancing a reverse mortgage would be reserved for situations where Natasha would need to be added to the loan. And usually she would be added, or they would consider adding her to the loan when she turns 62. If more equity is needed, or if the interest rate can be lowered substantially. So the good news is that Gregory and Natasha have time. And of course, the program is always changing. So for generational wealth, at this time, they don't see a benefit to their family, for their family to have a reverse mortgage. But of course, we just went through the different ways that they can get the equity out of their home, and reverse mortgages was one of them. So next week, I'm going to be talking about how much they would actually get when Gregory turns 62. Because we did it based on the interest rate at the time and the home value. So hopefully you'll come back next week and check it out. Thank you for stopping by, and I hope this information was beneficial to you. Again, I'm going to be including some links in the description below, and also including the playlist going through the different parts of the reverse mortgage. So again, have a fantastic weekend and Merry Christmas.